Shares for beginners.
And the copper-gold ratio has a very, very strong correlation with the 10-year yield. And if you graph it over the past 30 years, you say, that's odd. That's so correlated, that's amazing. So what you see now is that the 10-year yield is wavering. And it's basically going down again, which is remarkable because we are in a highly inflationary environment. This highly inflationary environment usually needs bond yields to go up to stop inflation from running wild. But now the market says they won't raise that high.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. And today, I'm happy to welcome back to the chair Peter Bakker from Unhedged. G'day Peter, how's it going?
It's going really well. How are you, Phil?
Good. Well, that wasn't the way you said it when you first walked in. And we've both been whinging to each other. But so, we talked, I think was in January, February this year.
Yeah, the beginning of the year, yeah.
Yeah,
correct.
Unhedged, which is an algorithmic trading platform. So just remind listeners again what this is, because it sounds frightening and scary, and it's kind of like we're always hearing that the algorithms are running the markets, or it's almost like there's conspiracy theories about it. But,
the tin head.
They're the tin
I can put my tin hat on and then tell you what we're doing. So algorithmic investing is basically a type of investing what is between passive and active. So yes, we take positions in the market, but we are guarding those positions every second. And the algorithms, they work what they call on probability. So they estimate the probability that there's a market rout, or they estimate the probability that a company has bad numbers, and then it will decide to go out or go in. It's basically more flexible. The biggest difference between, let's call them out, Spaceship, StockSpot, Raise, and us, is that those companies have static portfolios. So they work with like 5 to 7 ETFs. And it's a great way of investing, right? So don't get me wrong. But it's less flexible. So it does always the same in the same market. So what we're doing, we have a universe, what we call it, of the Russell 3000, which is the 3,000 biggest companies in the US.
And it's all US.
It's all US based
markets that you're trading in.
At the moment, it's only US based, but later we will go into Australia and London and other areas. Now it's only US based, so we take the Russell 3000 as our universe, and then we find the best opportunities based on the type of algorithm. So we have one algorithm that looks at momentum, and then it looks for it predicts where the bottom of the curve is, and then it buys in and it waits until it goes up. Another algorithm that we are running is about metals. So it looks at the industrial metals, so copper and iron and things we use, versus the more hedging metals, so gold and silver and platinum. And what we then do is look at the relative performance and the relative trajectory, and then we decide whether it's more a bull or a bear market, and we position ourselves accordingly. And then the last one we have live now is a really interesting, if you're a mathematician, for me it's interesting. Yeah. An interesting model. It's basically a model which we call hierarchical risk parity.
Sorry, repeat that again.
Hierarchical.
Yeah.
Risk parity. So what it basically does, it looks at all the sectors in the US, and then it determines how much risk a sector has, and then it basically underweights or overweights sectors. So it's been amazing that this algorithm has been live from January this year to now, and it actually has done a plus 2%, which is remarkable because the US market is down, what is still 12, 13%.
Yeah, and it had dropped down to, what, 20-something
Yeah,
percent?
23. It depends on which index.
Yeah,
you get.
yeah.
I mean, the Nasdaq went down almost to 30, right? So it's painful. And so this is the biggest difference between static investing and more dynamic. What we're doing is that our primary goal is not to lose too much money. And the absolute passive investors, they say, I don't care how much I lose, I just add money.
Yeah.
Right. So this is just a different view. And
ride out those market ups and downs.
yeah,
over
and
the
we
long term,
tend to lower the volatility quite a bit, and that's important for people's heart, right? Because if you don't lose too much, you don't have to earn it all back. We have accounts with all our competitors, and in the same period that this algorithm did a positive, we saw some of our competitors going down 47%, which is horrible for people who were invested.
So, Peter, is your background in mathematics?
In the end, I'm a statistician.
Okay,
So
yeah.
Is that mathematics? Well, for a lot of people it is. Yeah. So I started, I'm an old man, right? So I started studying in 91 after I came out of the army. And I started studying rocket science, or aerospace, they call it. The technology is a lot about mathematics and models, and very interesting. But I missed really the human side. So then I started to do a second study next to it, doing sociology. And
Well, that's so opposite.
that's like the polar opposite. I just fell in love with it. And then, but because I'm really like a math guy, I decided to do statistics. Statistics is now basically the only thing I'm doing.
So how does the maths work in this? Sorry, I know that you can't give really specifics about it, but there's a lot of people who say, well, you can't second guess the markets, you can't predict the markets. But is it kind of like a pattern identification thing that you're doing, or?
So basically, you have to go back to the types of statistics there are. So I grew up as what they call a frequentist statistician, right? So that's how frequent does something happen. Then in the last 20 years, Bayesian statistics became more popular. And Bayesian statistics basically looks at the probability of something happening, and then also how influential the event is that could happen. So basically, sometimes you hear people talking about fat tails.
Yeah.
So if a fat tail is there, then there's a relatively high probability that an extraordinary event can happen. But it depends on how big the result is. So in real life, a nuclear war, the probability of that happening is really, really, really tiny. But the effects are devastating, right? So it's still important that you still consider that scenario because the effect is so big. So if you have tail events in your strategy that could wipe you out completely, you still have to consider it. While a frequentist would say, oh, the chances are nil, so I just ignore it. And that's where, I don't know if you remember, 2018, there was a fund in the US that blew up on a strategy on gas and options. And suddenly the gas moved in a very different direction for whatever reason, and the whole fund blew up immediately. So what they did is they ignored their tail risk. While if you are a Bayesian statistician, you would always cover your tail.
So that's almost like an individual investor needs to think about their tail risk as well, don't they?
Yes, absolutely. I mean, I think a lot of investors who were in crypto have found a tail risk very in their face, right? So the tail risk of the model of Luna not working was actually very much there. But most people say, those guys are so smart.
Is that the brokerage that you're referring to, Luna?
No, Luna was the the coin that imploded.
Oh, okay, yeah.
And that set off basically a whole chain reaction of events. And with those chain reaction, that's also like a tail risk, right? So we could all say the brokerages, they were safe. Yeah, but there was a tail risk that something they invested heavily in was going to implode. And they didn't really see that. But we have, in our space, we have usually better regulation around it, right? So because Unhedged is a regulated entity, we are not allowed to take those risks, and we won't take them. We have to describe any risk in our PDS, and we have, of course, a lot of procedures to take away all the tail risk.
And of course, you should, consult a licensed financial planner before investing anything.
Oh no, absolutely, and often people say that out of you should talk to a financial advisor, but in real life, your life will change all the time, right? So your strategy should also be adjusted to it. And if you do not want to put the effort in to learn about it, which most people have better things to do, raising their kids and doing
You've
fun
got to be
stuff.
passionate about it too.
Yeah, you have
be able to work
like you. I mean, you just love to talk about this stuff, and I do as well. But a lot of my friends say, "Oh yeah, that's sure. Yeah, I'll just invest."
Well, the reason why I asked you back, first of all, I know that you're going to be bringing a couple of products out to market, which we'll talk about in a moment. But I guess just from my own personal experience, and again, please don't do anything based on what I'm saying here. Don't listen to me for financial advice. However, I put a little bit of money into Unhedged earlier in this year when you first launched. And I was very surprised about how little it went down compared to how much the US market went down. And now we're at a point where the US market has been recovering, and it's been going down a little bit more. It hasn't recovered. So what are the algorithms doing?
Well, the algorithms are looking at probabilities, and the probability that this is a bear market bounce or a bear market rally or a dead cat bounce, or how you call it.
I'll just date stamp this because this might be a couple of weeks before it comes out. So we're recording on August the 17th. So things may have changed, but anyway.
So if you look at the bottom of a curve, is hard to detect, right? So because the curve always has like bounces in it, and you don't know how high the bounce can go. Now, if you look at the current market situation in the US, we're now around 4,200 in the S&P. Which is kind of a critical level. And it's a critical level not because of any technical analysis, but if you look at the volume traded around that level, it's a very substantial traded level. So if you cross substantial traded levels in the markets, then there tend to be a large group of people that are either in profit or in loss. So people will decide either I'll jump out, because now I'm again neutral, or I will short it, or I will double down. Right, so that's basically the three things you can do.
And there's those opposing forces acting against each other.
Exactly. And why are bear markets rally so vicious is because of shorting in general, right? So people go short. That means that they sell a share they don't have. So you borrow a share from somebody else and then you sell it. And if you are short, then you profit from when the market goes down. Now, when the market reverses, then you start to lose money.
As it goes up again.
And you
can lose viciously as well.
Yeah, and then all these people who were short, they have to buy. They have to buy back their assets to give it back to you, to give it back to the guy who they borrowed it from. And so it means that these rallies are becoming often very vicious, very, very steep up, until all the shorters are again neutral. And then it's the question of whether the bulls take over and run further, or whether it neutralizes. We're right in that phase. And by the time you publish, we probably know what happened. But the algorithms indeed are still defensive, and they're defensive because the probability that this is a bear market rally is still substantially high. And there's a few things that are really standing out, and I know all my models, so I will pick out a few small nuggets.
Some points, yeah.
But one of the things is that you have a ratio, it's called the copper-gold ratio. And the copper-gold ratio has a very, very strong correlation with the 10-year yield. And if you graph it over the past 30 years, you say, that's odd. That's so correlated, that's amazing. So what you see now is that the 10-year yield is...
Which is a bond price.
It's a bond price of the 10-year bonds that the U.S. Treasury sells. That bond yield is wavering. And it's basically going down again, which is remarkable because we are in a highly inflationary environment. This highly inflationary environment usually needs bond yields to go up to stop inflation from running wild. But now the market says they won't raise that high. They won't raise beyond 3-4%. We don't know if that will be true, but that's what the market now says. Which basically means that if you look then at the copper-gold ratio, says actually there will be a recession. If there would be a recession, the market would go down. But if first the rates go down, then the markets will go up. So these are basically very contradictory signals. The moment a AI or machine learning model finds contradictory signals, it usually does one of two things. It does nothing. Or it does something defensive. And our models are programmed very defensively. Because this old adage, if you lose 50% of your money, you have to double it again to become neutral. If you lose only 10% of your money, you only have to make 11% up to become neutral. So our models are programmed to be very defensive and not to lose too much when the market goes down, and try to profit from the way up. But it always means that we miss, in general, the first tick up. So does that answer the question? It's a little bit of a long-winded
No, it's a really interesting insight to me, to see how markets work, because obviously in these figures and these ratios is a lot of market psychology is wrapped up in it, and the mentality behind the people in the industry that are affecting the movement of the money in and out of the markets.
Yes. Yeah. And then we should, I think, always talk about inflation lately. Milton Friedman, he won several big prizes and a very famous economist. He said the primary cause of inflation is always the creation of money. And there has been so much money created. So
around the world.
Insane
amounts of money.
And that means that people who say now, the inflation is transitory, they don't really understand what the base mechanisms of inflation are. And you can often see when inflation becomes more sticky, and that's when inflation goes in wages, because then it becomes a spiral. So if people get paid more, companies have higher costs, they have to charge those costs, so they will raise their prices. And raising prices makes life more expensive. And then, which is for me something always fascinating, is all these movements of these currencies, right? So why do they move? And which is extremely fascinating. Lots of people make lots of models about it, and nobody knows exactly what's going to happen because it has to do with so many factors. And that's frankly, Phil, why I think, and my team thinks, and a lot of our clients think, that algorithmic investing is a lot more accurate way of investing than static rebalancing. Is that the world is not a linear place. This is not, you can't draw a line from A to B. All the things in the world are non-linear models. And if you add non-linear models to each other, then the effect becomes so hard to see.
Is this the old butterfly in the Amazon analogy?
Yeah, that's
setting off a hurricane.
Well, that's more about the
chaos,
the effect of things that you cannot see. But our world of economy exists out of thousands, millions of processes which are all non-linear. So yes, often we can find a probability of something happening, but that doesn't mean that it will happen. There's a probability.
Well, let's have a chat about the new products that you're here to announce today.
Very exciting.
Yeah.
Very exciting. So we asked our clients, so what would make you invest more? And they answered 3 things. The market has to go up, crypto, and ESG or responsible investing. And then we dug a little bit deeper, and then we also looked at why do people invest. And it's basically most people invest for growth. So they want to build their nest egg for whatever goal. And then you have a group of people who are older who say, well, I want to park some money and then get every month money out. So
income generating.
In income or in the end, eat part of your capital, but in a very responsible way. So the first thing we're going to launch is what we call a climate and society positive investment strategy. We did a lot of analysis on all the goals of the Paris 2015 agreements, and we looked at how can we invest in companies that as a whole will either have limited or a positive influence on the climate. So they basically reduce their hothouse gases. Then we looked at, there's not only the companies, for example, Apple. It's not only what Apple does, but also what Apple forces their supply chain to do. So what we did is made a massive model of all the companies in the US. And we made what they call a graph, and we looked at all the supply chain. And then we look at how the supply chain and the companies on top are improving. Because we believe, and I think more and more scientists are in the same camp, this is not about an absolute number. This is not only about this house should only have this much exhaust, or this company should only do X. It's about improvement, because every improvement is a conscious effort. You cannot improve without actually trying. So if we see that the supply chain is improving, either the management themselves do it or they get forced by their clients. So that's the hypothesis. And what we have seen is that if you look at the long term, and this is really predictive, we look at whether the cost in the end will increase because of climate costs, because of taxation, because of other elements or customers leaving them, or whether their revenue can be enhanced by being more climate friendly and society friendly. And so that's what we did, and we found a model that actually does as good as or better than the market at times, and we expect that this will only grow. We still have to go through all the regulatory hoops, because ASIC has made a lot of guidance around greenwashing.
Yeah, that's one of their major targets at the moment, isn't it?
Yeah, and good for them, right? Because greenwashing is horrible. If you look at most what they call ESG ETFs or responsible investing ETFs, they're full of companies like Google, Apple. For example, NVIDIA. NVIDIA was a fabless or someone who did not produce any physical product, right? For a while. So they were called fabless. So they were an ESG company because they didn't have a physical product. Now they're making board themselves, and now they went down in the rankings. Well, that's silly, right? The fact that a company doesn't make a physical product doesn't mean it's a climate positive company. There's a lot of more variables that you have to take into account. And for people who like climate positive investing, they really should look at the ETFs they invest in and what's in it. If you look what's in it, and you think, but that has nothing to do with the climate. And that's the fallacy we want to really step out of. We say, what if we just look at companies consciously improving? It's the progress and the process we think we should promote rather than the end goal. Because the end goal, even if we get at the Paris agreements, we will have another goal behind that, right? So this is just a process, and we should really help companies to say, okay, we invest in you because we believe that you do this consciously, and this is a conscious effort.
And then the income fund?
The income fund is there's plenty of income funds for, let's say, very rich people, right? So they put a part of their money into annuities, and then they get every month a distribution. For people who have funds that they want to do that with, but still want the fund to be available, it's really hard to do that. And so what we have done is created a model that basically looks at companies that have very good and sustainable dividends and high-yield bonds. So companies often have bonds that, although they have enough cash to do the project themselves, they just want to borrow the money to do it. And those bonds are paying good coupons and good interest, and they're pretty safe. So although the model will go up and down a little bit with the market and what they call multiple expansion and contraction, in the end, the goal is to create a steady income of, like, say, 3, 4, 5% a year, and then letting people get that money every month. So we are launching next month Auto Invest. So that's basically after your salary gets paid, so you invest automatically, which is the best way to get rich in the end, is just to invest every month, same time. Yep. Every week, same time. We're also going to reverse that. We have an auto withdraw. And that means that people can say, well, I put $100,000 in here and I want to get every month $1,000 from it. And then they eat slowly a little bit in their capital, but they know they get every month.
So it becomes like an annuity, really.
Yeah, but then when you need your capital to buy a new car or when you buy a new house, you still can get it.
So it's flexible, completely flexible.
Yeah, it's totally flexible. Well, if you have an annuity, you usually have to lock it down for many years, or even they calculate it such that the whole principal will be gone by the time you die, and they take a risk on that, right?
Yeah.
It's a different type of model. So we really believe that it's your money. You should be able to access it any day, anytime you want.
When you're investing in Unhedged, can you weight your portfolio into these different kinds of models that are being offered? Yeah.
Most people take equal weight. And equal weight means that you just take an equal part of the algorithms. And that means that in backtesting, that showed the least volatile outcome. Yeah? But with the launch of the new models, they are more theme-based, right? So the climate and society positive model, it's more about whether you think that's more important than to have a very diversified portfolio.
So it becomes opt-in, does it?
Yeah.
Yeah.
And so you can put 100% in climate positive. You also can put 100% in yield if that's what you want. But you also can create a portfolio all over, right? And say, listen, I want the machine to calculate the best weighting across all those. And we expected actually more people to make their own weighting. But we see most people say, let the machine do it for me.
Yep.
And that's, I mean, as you have seen, that gives a result that is less volatile, and for most people, that's what it needs to do.
Fantastic. So if people want to find out more about Unhedged,
go to unhedged.com.eu.
And there's an app as well, isn't there?
And there's an app, right? So you can look in the app stores under Unhedged. Don't type unhinged, because as a Dutchman, people say, sorry, you said unhinged? No, unhedged.
Unhedged.
Unhedged. We're launching a refer your friend model in the next few weeks. So you can earn $10 if you refer your friends. And just try it out.
What's the minimum investment?
Minimum investment is $100. It's really cheap. Well, cheap is really low. What we've seen, though, is that a lot of people, they try with a little amount of money, so like $200-300, and then after a month, they just add 1,000 or a few thousand. So it's remarkable that we see a lot of people trying it, and then when they see that it indeed does what it should do, they put more money in.
Fantastic. Peter Bakker, thank you very much for joining me again today.
Very welcome.
If you found this podcast helpful, please tell a friend, especially if it's someone who needs to start thinking about investing for their future. You'll be helping them and helping me to keep this show on the road.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
And thank you for listening to my podcast.